Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello everyone, my name's Manpreet and welcome to Through the Noise. Now we're recording this on a day when bond yields are starting to push a little bit higher, and the conversation's inevitably returning to the risk to inflation after the US released the CPI data, and of course how much of that is linked to oil prices and the conflict in the Middle East. Now, I guess the key question here is this an opportunity for investors to lock in yields and opportunities across different asset classes, or should investors be putting hedges in place? So to discuss this question and more, today I'm very happy to be joined by Fook Hien, Senior Investment Strategist in the CIO office. Welcome, Fook Hien. Always good to speak with you. Let's start with the key topic. I think in this week's note, you do discuss a potential tipping point when it comes to the Strait of Hormuz blockade, especially as we start to approach the summer holiday season. But in your view, how do you see this blockade evolving, and what do you see as the big policy implications?
Yeah, hi, Manpreet. Thanks. The ongoing blockade of the Hormuz Strait is reaching a tipping point as the summer holiday season approaches. Now we see the Trump and Xi summit in China. It has the potential to lift the blockade. Both leaders have agreed that the Hormuz Strait must remain open, with China's leverage over Iran being its biggest oil customer a key factor. So should China act on the pledge, shipping through Hormuz could resume in weeks, and such a development would lower oil prices and relax global financial conditions, sustaining the rally in risk assets. Any persistence of the Hormuz blockade remains a risk to our constructive outlook, and should the impasse continue into the peak summer driving and travel season, then global oil inventories, which has been bolstered so far by elevated reserves and strategic stockpile releases, they are likely to decline sharply. And this would then lead to upward pressure on oil prices and heightened economic strain. So far, we have seen the hot inflation in the US, but the jobs data has been resilient. US inflation accelerated sharply in April due to higher energy costs. Despite these increases, secondary inflation effects remain limited for now. Meanwhile, the US job market has rebounded from last year's downturn, with job creation stabilizing the unemployment rate slightly above the Fed's long-run equilibrium. Against this backdrop, the Fed is likely to keep interest rates steady. The bar for a rate hike is high in our view. Only a loss of confidence in long-term inflation expectations or an acceleration in wage growth would likely prompt action. Conversely, if the delayed effects of the oil shock undermines growth, the Fed may then have to resort to cutting rates later this year.
All right, I think that's a great overview. But building on that, against that backdrop, how should investors be positioning investment portfolios at this stage?
Yeah, we are still pro-risk, but we would avoid concentration risk. So a US-China, if there's a joint push following the Trump-Xi meeting that could lift the Strait blockade, it would lower oil prices and bond yields and the US dollar. Now, this would help sustain the rally in risk assets, particularly in China and India equities, which have missed this year's rally in Asia equities. But while the medium-term outlook remains constructive for risk assets, US equity market investor positioning is now less attractive than a month ago. Hence, we remain positioned to navigate volatility by minimizing concentration risk. Meanwhile, firms with strong pricing power are expected to outperform if inflation persists. So broadening exposure to technology, especially the internet industries, remains a preferred investment strategy. Emerging market bonds and Australian dollar bonds are also likely to benefit. A prolonged Strait blockade is a risk to our constructive outlook, and so we continue to hedge against stagflation risk through U.S. inflation-linked bonds, gold, and alternative assets.
All right, I think interesting you mentioned inflation-linked bonds, because the other key event last week was, of course, the U.S. Consumer inflation data. How does that impact your view on U.S. government bond yields?
Yeah, we expect the firmer US consumer inflation print to maintain near term upward pressure on the 10-year US government bond yield. The higher than expected US consumer inflation in April showed 3.8% year on year growth. This suggests that the market will scale back expectations for near term Fed easing and, at the margin, revive concerns about further tightening. Nevertheless, the latest inflation rise is not broad based. Much of the upside stemmed from energy, food, airfares, and a one off shelter distortion. Meanwhile, the core goods inflation was flat, wage growth remains contained, and long term inflation expectations remain anchored. As a result, we see the strong headline consumer inflation data as likely to push the 10-year government bond yields higher initially, with the yield potentially reaching resistance at around 4.5%. And if the pressure persists, it could test the next resistance level at around 4.6%, which was a level last seen in May 2025. Our 3-month estimated range for the 10-year US government bond yield is 4.25 to 4.5%, and this view remains intact, but any bouts of inflation pressures are expected to lead to a temporary breach of this range.
Now, thanks, Fook. And what about the impact of the fact that we'll have a new Fed chair? Do you expect Kevin Warsh to steer market expectations away from a neutral Fed stance?
Yeah, we believe Warsh is unlikely to steer the Fed away from its neutral stance in the near term. That's because the current economic backdrop is not conducive to a dovish Fed pivot, especially given that the latest US consumer inflation reading remains elevated at 3.8% growth year over year, which is a level not seen since 2023. Now, during a CNBC interview in April, President Trump did say that he would be disappointed if incoming Fed Chair Warsh did not cut rates. However, we expect Warsh to prioritize inflation credibility over accommodation. In addition, he is expected to rely less on balance sheet tools, which will further constrain the room to ease policy, particularly in the early stages of his tenure as the Fed Chair. That said, Walsh he believes in the disinflationary benefits of AI-driven productivity gains. As a result, we think the odds of a shift away from this neutral stance could rise if the Middle East conflict subsides and the U.S. labor market weakness becomes more evident in the second half of 2026.
Okay, and finally, amidst all that focus on the US and US inflation, we also have an ongoing earnings season in China. So, in your view, what are the key takeaways from major Chinese tech company earnings so far?
Yeah, we maintain our bullish view on the Hang Seng Technology Index. We still see reasonable valuations and improving growth visibility provide scope to increase exposure here. China's tech sector delivered a strong Q1 earnings, which is reinforcing AI or artificial intelligence as the dominant driver. So, according to Bloomberg, as of 14th of May, the aggregate EPS growth for the IT sector has more than doubled. AI adoption is broadened beyond the IT sector, particularly into consumer discretionary such as electric vehicles and e-commerce, and also in communication services such as in gaming, which all recorded positive revenue growth. So a few catalysts underpin our expectations of further upside here. One is an inflection in monetization. We see early revenue traction among the immediate AI beneficiaries, including enterprise software and advertising and marketing. Two is CapEx expansion. So rising investments in segments such as semiconductors and energy infrastructure will support the build-out needed to meet the commercial AI demand. And three is macro support. Stabilizing retail sales and elevated oil prices have supported profitability in select consumer discretionary segments, such as electric vehicles or EVs. So the Hang Seng Tech now trades at around 19 times 12-month forward price to earnings ratio, which is below its 5-year average, and thus we believe it's offering an attractive entry point.
All right. Thanks, Fook. I think we leave the conversation at that bullish point. As I think we're out of time. Thanks so much for speaking to our listeners today. If I can summarize what I saw as the top takeaways from today's conversation. Number one, we think the environment, of course, and particularly with the US and China conversation, positive for emerging market and Aussie dollar denominated bonds. Second, on the whole inflation conversation, possible we see a temporary breach higher in US bond yields, but that, of course, may represent opportunity. But of course, keep those inflation-protected bonds as a hedge. And third, from a Chinese earnings season, we see an attractive entry point into the Hang Seng Technology Index from an equity market perspective. So thank you very much for listening in to today's conversation. We hope you enjoyed that, and we look forward to speaking with you again next week.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.